welcome to the first of our upcoming video series. We've decided to put just some short videos together on some investment and financial planning principles, and we'll be sharing those videos with our clients on our client base or on our mailing list, as well as anyone else who's interested in these topics. So today I'll be going over something fairly general, which is just some basic principles around investments and the different types of asset classes. Okay, so the first principle that I'd like to share today is the idea that you can get your rate of return as an investor from two main areas. So the first area is what we call growth or capital growth, and really that's the difference in price from when you buy an asset to when you sell it. So an example of that would be your house. If you bought it for say $500,000 and then you sell it for $550,000, you've had some growth or a growth amount of $50,000 in that transaction. The second area where you can get a rate of return is what we call income, so the income component. And if we use the same example, so the house, the income return that you get from that investment would be if you decided to rent it out and you got some rental income. So that forms the income part of the return. And when we add both of those components together, so growth and income, that's how you get the total rate of return on whatever your investment is. And to figure out what that is as a percentage, we just divide that by the value of the asset. Okay, so the second main principle that we'd like to go over is the idea that there are four main asset classes available to you as an investor, and how the different types of assets are classified really depends on whether or not they move up and down in value and how they behave. So the first of these is cash, which includes any kind of savings accounts, money in the bank or term deposits, and this is a very low risk but also low return type of investment. Following that comes fixed interest or bonds, and these are also low risk but probably slightly, they move slightly more up and down compared to cash. Following that comes property, which includes anything along the lines of residential property, commercial property, any kind of industrial property, and from that kind of investment you could usually expect a slightly higher return compared to cash or bonds. And lastly comes shares. Shares would be considered the most risky in terms of how much they move up and down, but they do tend to give you the highest rate of return over the long term as well. There's also collectibles and commodities and things like that that investors can choose from, but we'll stick to the main four at this stage. So as an investor, you've either got cash, bonds, property or shares that you can choose from. And the last principle that we'd like to go over today is the idea that of those four investments or investment classes, they can be broken down even further into what we'd call defensive and growth assets. So on the defensive side, cash and bonds fit into that mix, and that's mainly because as an investor you really only get a rate of return from the income generated from those investments. They don't move around a whole lot in their value. On the growth side, property and shares fall into that category, and that's mainly because as an investor you can get a rate of return from the growth, so the change in the value of that asset, as well as the income that they generate. So in property and shares case, that's rental income or dividends. this gives you a good overview on the different types of investments available to you as an investor and how they tend to behave. And of course, any kind of good investment plan will have a mix of all of these types of investments relative to what you're trying to achieve and to what your goals are. So thanks a lot for watching, and we'll see you next time.